to another Invest in Myself video. So there's one thing that you guys need to know. There's only a couple guarantees in life. That's death, taxes, and these weekly videos that I upload for you guys. So if you haven't done so yet, go ahead and hit that subscribe button, that like button, help a brother out build his YouTube channel. Well, today we are going to be talking about why velocity banking is better than adding an additional payment when paying off your loan. All right, so we're gonna get straight down to it. We have Vic and Victoria, and they have gotten themselves into some debt again. So we're just gonna start breaking it down here. We have a loan of $10,000. The interest on the loan is gonna be 6%, and the period of the loan is gonna be 2 years. So Vic and Victoria, their income is gonna be $4,000 per month. Their expenses are $3,500, and their cash flow is $500. Now they are going to use a line of credit. Their line of credit is going to be $8,000, and I am going to show them why velocity banking is going to be better than just paying double payments on this loan. All right, so first thing we need to know is how is amortized interest calculated when you are paying down your loan. This can be any type of loan: car loan, personal loan, student loans. So the way it's paid down is it is front loaded, meaning that the interest for your first payment is always going to be the highest, and your last payment, the interest is going to be the lowest. So let's look at the chart here. So we have for the interest $50 when you make that first payment. Second payment is going to be $48. Third payment, $46, $44, and it just keeps on going down from there. So what the velocity banking method does is it allows us to chunk at the loan and make the amortized interest even less. So for example, if we make a chunk and it makes our payment go down to the 12th payment, we're only going to pay 27.82% interest. So I'm going to break it down to you guys even more here. So let's say Vic and Victoria, they're going to be using the common way that we've learned growing up how to pay less in interest, and that's pretty much make double payments. So this is how it's calculated when you make these double payments on a loan. So we're going to go to the first month here. What's going to happen is the total payment, or the payment, is $443.21 that they have to pay per month. What they're going to do here, they're going to add an extra payment of $443.21. When that happens, this is how it's calculated. So on the first payment, the interest is $50. Now, since they made double payments, it's like we paid 2 months. So for the first month, it's going to be $50 in interest that we pay. This makes it skip to month 3, since we paid 2 months since they paid a principal payment. Now, on the third month, when they do another 2 months worth of payments, we're going to pay this $46 of interest, and then it's going to go down right here. So ideally, we avoided the $48 since it skipped to month 3, and then we avoided the $44 since it skipped to month 5. So do you see how when we do the extra payments, we're skipping a month, so we don't have to pay that particular interest every month? All right, so I'm going to give an example of how people normally pay down their loan to avoid interest. Now, what we normally do and what we have been taught is if we make extra payments to the principal, then it is going to save us in interest, and that is true. So let's examine how this savings works. So Victoria and Vic, what they're going to do the first month, we're going to add an extra payment of $443 to the regular payment. So they're paying a normal payment for 1 month, and then they're adding to the principal. What happens is the first month, we're going to pay $50 in interest. Since we had a principal payment where they're paying 2 months worth, then what happens is we pay the $50 of interest, we skip the $48.03 of interest, and we go down to right here because it's amortized. So since we made 2 payments for 1 month, we're going to skip this interest, and now we go right here. So on the next month, when he makes a payment, he's going to pay $46.06 of interest, not the $48.03, because they paid an extra payment and they're going to skip that. So they've saved $48 of interest. Now, when they make a double payment again, it goes from month 3 to month 5. So they just saved $44.07 because they made a double payment for that month. So now when they're on month 5, when they make a payment, they're going to pay $42.08 in interest. Again, this is going to skip month 6 because they made an extra double payment and then go to that month. So if we calculate this, they've saved $48, they saved $44, $40, so they saved about $120, and this would keep on going down. So when we calculate these extra payments, then we are going to save about $200 worth of interest. So let's say in 6 months, since you're doing extra payments, it would get you to month 12. We saved right here, we saved right here, 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 and there. If we add that totally up, it's about a little over $200 in interest we saved for making extra payments. Now we are going to use the velocity banking strategy. Now, if you have not seen the first video, Only Dummies Save Money, please pause this video. The link is down below, and go ahead and watch the video so you can get caught up to speed, because we will aggressively accelerate over the velocity banking method, because I assume you guys will know a little bit about it. All right. So what we are going to do for the velocity banking method, what I tell Vic and Victoria to do, they are going to use their line of credit, and they are going to use $4,041.83. So that's about a little over half of their line of credit for an extra payment on top of their $443.21 payment that they have to do for the first month. If we add both of those payments together, it's going to give us an ending balance of this $5,564.96 since we put the $4,000 on there. So since this is an amortized interest loan and we chunked so much money on there, we are actually on month 12. Remember the double payments, every time you put 2 payments, you skip that 1 month. Since we did a chunk and we're down to month 12, we skipped all month 1 through 11. So all this interest, we skipped. So if we look at it here, the interest that we saved for that 1 chunk, the total interest is $468.05 by using that chunk for the line of credit. Now remember the double payment, we paid this first month, it skipped over, and then we had to pay interest here, 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 and there. We are not saving as much interest as if we chunked our line of credit on there. Now, the reason why we would only chunk about $4,000 or half of our line of credit, because remember, our line of credit is our checking account, our savings account, our emergency fund. So if something happened, we have $4,000 to lay back on. Now remember, with velocity banking, since this is our checking account, when we get our income of $4,000, the first thing that we are going to do is put all our income onto our line of credit to pay that almost in full. Now remember, the more that you have in your line of credit, the less interest you have to pay. Now pause. If you guys have not seen the video how to calculate simple interest when using a line of credit, please go ahead and click the link down below. Save this for your favorites. Go watch that and come back. Now, since we have used the $4,000 of our line of credit, and then we get our income in of $4,000 to put onto the line of credit, it's going to stop interest from accruing. Now, periodically, you're going to have to pay your expenses on there. So whatever you need for expenses for that day, you're going to shuffle that and pay it off with your line of credit. Keep shuffling that out. Now remember, our expenses are $3,500. So what's going to be left on the line of credit is always $500. And then the next month, that's 500 more to equal 1,000, 1,500, 2,000. So eventually you are going to build your line of credit up to make another chunk payment. Now the one thing that we have to take note too, for our expenses, the $3,500, our payment of $443.21 is included in our expenses. So while we are building up our line of credit, we are still paying down the loan. Now remember, since we did that chunk and we skipped all the way down to month 12, when we make our next month's payment, month 2, when we make our next month's payment, we're only going to pay $27.82 in interest. So for month 2, we're putting more towards the principal than if we made just an extra payment, because it would have skipped down to just to month 3. So the principal, we would only pay $397 towards the balance. Now we're paying $415.38 towards the balance, since we chunked it all the way to month 12. All right, so since we skipped down to month 12, our second month's payment is going to be month 12. So we're just going to do our regular payment of $443.21. We're going to have more towards the principal, and this is how much interest we need to pay. Now, since we're using the velocity banking method, when we have our income minus our expenses, we're putting the income into the line of credit, and then we are taking our expenses out. The cash flow is going to be of $500, and we're going to keep that in our line of credit. Since we use $4,000 of our line of credit, it's going to take us what, 8 months? All right, so if you're looking at the board, we have months 13 through 24. Remember, the loan is a 2-year loan, and since we used our line of credit to chunk at the loan, we chunked the extra $4,000 off of it. We've completed months 1 through 12 already, so when we start our second month, we're on month 13 of the amortized calendar. Now, since we are on month 13, we are still going to put our payment of $443.21, because that is just part of our expenses. And then for our line of credit, since we have a cash flow of $500, that's going to leave $1,000 out of the $4,000 that we owe on the line of credit, since we chunked $4,000 at the beginning for the first month and saved about $400 worth of interest. So this leaves our ending balance for month 13 at $4,732. Now we go to month 14. So we're going to apply that $443.21 payment. And this is the interest that we're paying since it's amortized, and we're already on month 14, even though we're on month 3. Now we go on amortize month 14. We're going to pay our $443.21. And this is how much we are applying that payment towards the principal. So $419.55 is being applied towards the principal. We're only paying $23.66 towards interest. Since we made that chunk payment and it skipped all those months, we saved all that interest. So our next payments are going to be the amortized months of 14. So it's going to leave our ending balance at $4,312. And remember, this is the third month. So our cash flow of $500, if we times that by 3, that's $1,500 in our line of credit. So we're steadily paying back our line of credit and still paying down the amortized loan. So our ending balance of month 14 is $4,312.58. Now we're going to move to month 15. So we still have that same beginning balance of a little over $4,300. We're going to apply our payment of the $443.21 payment. This is how much is going towards principal. This is how much is going towards interest. Our ending balance is a little over $3,800. Remember, when we're using the velocity banking, since our line of credit is our account, we're putting the $4,000 of our income into the line of credit, letting it sit there, and then when expenses come, the $3,500, then we're paying it out of our line of credit. So only simple interest is added on to the line of credit when it's not paid off in full from your income and you have to pay the expenses off. Since there is a cash flow and we are in month 4, we're going to have $2,000 of the $4,000 that we chunked on to the loan. All right, so we are on amortized month 16, which is really our month 4 of paying off this loan. So our balance a little over $3,800. We are going to use a payment, our monthly payment that we have to pay of $443.21. This is how much is applied towards the principal. This is how much interest that we're going to be paying. So our ending balance is going to be a little over $3,400. Again, we're going to be using the velocity banking method of putting our income onto the line of credit, paying our expenses. Our cash flow is $500. So now we are having $2,500 applied towards the line of credit that we chunked $4,000 on. So we're getting so close to paying off the line of credit to make our next chunk. All right, so now we're on amortized month 17, which is really month 6 in real life for us in regards to actually paying off our 2-year loan. So we're still going to be doing that same thing. The payment is $443.21. This much is going to be applied towards principal. This much is going to be applied towards interest. Going to leave us a little bit over $3,000 and $3,041. A little over $3,000. Now remember, since this is month 6, we're taking our income, putting it to the line of credit to minimize the simple interest, and then slowly paying our expenses off for the month. Leaves an extra $500 out of that line of credit. Since it's month 6, that's $3,000 on the line of credit, where we use $4,000 to chunk at the original loan of the $10,000. Now we are on amortized month 18, which is really month 7 for paying down the loan. So we're on month 7, and this is a 2-year loan. The beginning balance is a little over $3,041. We're going to make this simplistic. Now remember, our line of credit, we paid $3,000 of the $4,000 back. So we're just going to negate the $41.31. We can use our line of credit to pay off the entire loan. So once we make an extra payment, then it goes all the way down to month 24. So we've completed the loan to 0. Guess what this does? Since our monthly payment was $443.21, our cash flow increases by that much. So our cash flow is almost $1,000 a month now. Now remember, since we use that $3,000 out of our line of credit and we owed $4,000, we're going to owe $4,000 again for the line of credit. So now since we increase our cash flow from $500 to $900, we're going to use the velocity banking method, and we are going to put our income into the line of credit. Our expenses have been reduced by $443. So we're only paying about $3,000 of expenses, and then you're going to leave your cash flow into the line of credit. So since we're going to make the number simplistic, it would take us 4 months with $1,000 cash flow to complete the line of credit. So remember, we were on amortized month 18, which would actually be month 7 of us paying off the loan. If we add 4 more months, since our cash flow increased, because we chunked the $3,000 just to pay that off, remember, it would take us 4 extra months to pay down the line of credit. So 7 months plus 4, that's 11 months that we paid off everything. And again, since we chunked the payment to begin with, we are saving the amortized interest because it chunks the months. So for month 18, since we did that chunk, we saved this, and this, because we're not making monthly payments anymore. We completed that loan, and now we are using our line of credit as our account and slowly building that line of credit up, paying simple interest. Now, I know this may be a lot to comprehend, but the previous videos that I did mention, you want to go click on those links, review the videos so we can do the 101s, and then so you can understand why using your line of credit to chunk at an amortized loan saves all this interest, because you are skipping the months of the amortized interest and making it go towards, let's say, if we chunked from month 13 all the way down to month 22, we are saving this much's interest. And then we use our line of credit as our account. All right, so we are just going to do a brief recap of what we did so we can lay it down in layman's terms here. So we're going to go back to the double payment philosophy. So with double payments, you're going to get it done in half the time. So with a 2-year loan, if you make double payments, you'll get it done in a year. So that's going to be 12 months to pay off the loan. Now, if the full loan, the cumulative interest is $636.95. If you do double payments, you're ideally just going to be paying half that interest. So you saved about $300 worth of interest. Now, when we go to the velocity banking method, and I did switch the board over to month 1 through 12, when we make that first initial chunk payment out of our $8,000 a line of credit, the chunk payment of $4,041 with our regular payment to go all the way down to this month, we have saved this much interest already because it's amortized. So we have skipped all these payments, and since we didn't pay interest on all those payments, this is how much we saved right here, $468. That's already more interest that we've saved just by chunking that. And really quick, I did flip the board over to the second year of the amortization from 13 to 24, just to remind you guys, we did do another chunk payment around month 18, so that did save us interest on that back end as well. So if we're totaling up the $468 that we saved on the front end and around close to $50 on that back end. That's $500 of interest that we have saved. Now remember, the total cumulative interest, if we were just to pay it in a 2-year span, was $636. So we pretty much save close to about 75-80% on interest using the velocity banking method, as opposed to the double payments. We would have saved exactly half. Now remember, we paid off the loan using the velocity banking concept in 7 months. So by using the velocity banking concept, you are actually saving more in interest when you borrow from Peter. Remember, Peter is simple interest to pay Paul, which is the amortized interest of which we learned about. Now, one thing to remember, this is only a 2-year loan, but if we stretch this loan, let's say it's a student loan, 10-year loan, or even a mortgage of 30 years, there's going to be more interest in regards to the amortization, the months that you pay. So if we stretch this out, let's say this $10,000 loan to maybe 5 or 6 years, then if we use this velocity banking method, we are going to save even more money because we're stretching it out for a longer period of time with the amortization. We will be going over loans that stretch out even further in years so we can see the maximization of the savings. But I do want you guys just to get a concept of amortized interest, why we are using a line of credit to chunk at the payment, making the amortization table, let's say, down to 12 months. So when we do make our monthly payments, our interest that we're paying is going to be lower than opposed to making double payments of the 50, then the 46, then the 42. That's what you're paying interest on. We want to use our line of credit to pay off most of the loan and then pay simple interest back from the line of credit by using our line of credit as our banking account, as putting all our $4,000 into the line of credit, since we chunked $4,000 out, to pay it off in full to minimize the interest, and then slowly pay our expenses. Whatever's left, the cash flow, $500, we keep that in there. We're going to build that back up. Then we're going to be making another chunk to chunk the amortization table down even more to pay even less interest. This is the basic concept. Now, I hope this video has been very informative. Again, if you guys have not, please subscribe to the channel. Help the YouTube channel grow. Share this information with others. Go ahead and hit that thumbs up button. And I will be back with you guys next week with another Invest in Myself video. You guys take care.